Okay, I'm going to, this is chapter 11 of intermediate. This is third time's a charm because things haven't worked. So hopefully you have better success with this chapter than I do and have not wasted near as much time. But anyway, having said that, we're going to talk about depreciation, the factors involved. We have 4 methods of depreciation, 1, 2, 3, 4 methods of depreciation, and some other things that we're going to talk about. So I'm going to go just kind of through this PowerPoint just a little bit, but then I'm going to switch to some Excel things. So basically this is important, that depreciation is the systematic and rational allocation of the cost of an asset over its useful life. It not to be confused with impairments. An impairment is when it's not systematic and systematic. So you might have a sudden impairment, a sudden loss in value, or some other amount that's not systematic. So you can lose value by other ways than depreciation, but this chapter talks about depreciation. Little definition, fixed assets, we say we depreciate them. Intangibles, we say we amortize them. And natural resources, we say we deplete them. All of them are figured very similarly. So I'm probably not going to spend a whole lot of time on amortization and depletion. I believe you might have a problem on depletion, but amortization is almost exactly like straight line depreciation, and natural resources depletion is almost exactly like units of production depreciation. So the format is pretty similar. So basically, I want to know what the depreciable base is. So in the prior chapter, we talked about every cost to get the asset ready for its intended use is added to the cost of the asset. You add those up, and that total is right here. That's what, in this case, the cost of the crane. The invoice price may have been $300,000, and you may have had to assemble it, etc., etc. But after you add up all those costs to get the asset ready for its intended use, that's generally your depreciable base. Now there are other things that it could be. For instance, when we traded assets in the prior chapter, if you adjusted the new asset, new piece of equipment, if you traded one piece of equipment for the other, whatever you record the equipment for is your depreciable base. What's its useful life, which we'll talk about in a second, and which cost apportion method will you use? That's one of these, which we'll do them all. So basically your life of your asset can be based on physical factors. It can wear out, so we all know cars don't last forever. Or it can be economic factors. So you may have a cell phone that still works, but it doesn't work good enough for your business. So it is the life to your company is the life of that asset. So 2 different companies can have a same asset with a different life. Okay, so the different methods we're going to do, units of production or activity method, I generally call it units of production. Straight line, these are very similar. The formula is cost minus salvage value divided by life. Here the life will be in units, here the life will be in years. Then we have accelerated methods, where you take more in the first year, so that 2 are some of the year's digits in declining balance. So you'll see that depreciation expense is front-loaded in the earlier years. And then you have these 2, and we're just going to talk about those briefly when we get to them. Okay, so we're going to take this asset, and I'm going to pause it here because I'm going to go to an Excel spreadsheet. Okay, so we have the cost of the crane is $500,000. It's going to last 5 years. It's got a $50,000 salvage value. And we estimate it's going to, we can run that machine 30,000 hours. So as I said, for units of production in straight line, the formula is cost minus salvage value divided by life of the asset. So here I've got my cost minus salvage value. You don't necessarily have to subtotal depreciable basis of cost minus salvage value, but I'm going to show you that number is important for a few things. Divided by life. And in this case, it's going to be $15 per hour. So that per hour is kind of important. So it's like 30,000 hours, so it's 15,000 per hour. So in the first year, it says, what if I use it 4,000? So I'm going to have 4,000 hours times my $15. So my depreciation expense is $60,000. Um, so in all cases, no matter which number we come up with, your entry is going to be debit depreciation expense, credit accumulated depreciation. Don't follow the PowerPoint simply because it doesn't do a partial year, and some of your homework does. So if this asset was purchased on May 1st, the number of hours would simply be different, because if I bought it on January 1st, one would think that I would use it more hours than I'd done it on May 1st. So no, this is per hour, simply your number of hours would differ. So the journal entry would simply be the computation exactly the same, but you would use the hours given. This is the only one you really don't have to adjust the fraction of the year, because the depreciation is per hour, not per year. So the next one, straight line, my depreciation is based on life, and I have it for 5 years. So in this particular case, it is 90,000, but not per hour, per year. Okay, so for the first case, if I have it, if I purchased on January 1st, my entry is depreciation expense, accumulated depreciation, 90,000. Again, I would prefer you'd write this in fraction of 50,000 minus, 500,000 minus 50,000 divided by a life of 5 years is 90,000 a year. Okay, so then what happens if I purchase it on May 1st? Well, it's 90,000 per year, but I only owned it for 8 out of the 12 months, so my entry is 60,000. So again, your depreciation expense, accumulated depreciation, for a fraction a year, you just take it times the number of months. I will never have you count days. If for some reason you have a problem in the middle of a month, if it's on a test, it's a mistake from me. I wouldn't have intended to do that. But generally, you take a full month or a half a month. Okay, so next one we're going to go to some of the year's digits. Okay, in some of the year's digits, notice it has a 5-year life. What I do is I simply just add them up. 5 plus 4 plus 3 plus 2 plus 1. So that's 15. You can also use the formula, and the formula is n, which is the number, times n plus 1. So 5 plus 1 is 6, divided by 2, and you come up with 15 also. If you want to remember that formula, that's fine. A 12-year life, it honestly doesn't take too much time to even in your calculator do 12 plus 11 plus 10 plus 9, etc., etc. So you just sum up the years. All right, and then what happens is we take 5/15 in the first year, 4/15 in the second year, 3/15 in the fourth year, 2/15 in the fourth year, and 1/15 in the last year. So in our years, we always take the high number first. We always go down, because remember, it's an accelerated method. So in the end, 5 plus 4 plus 3 plus 2 plus 1 is 15. So in the end, we take 15/15, or 100% of the depreciation. So then all I do is my cost minus salvage value is 450,000. So you can put cost minus salvage value in there. But in all cases, except for double declining balance, we use salvage value in our computation. So we're going to depreciate $450,000. So in year 1, I simply take 5 divided by 15 times $450,000. In this one, I take 4 divided by 15 times $450,000, etc. So you can see that then it's 3/15, 2/15, and 1/15. So over the life of the asset, if I sum up all these numbers, I've taken $450,000 of depreciation, which makes sense because that's my depreciable basis. Also, just something that should be obvious, but sometimes it's easy, you miss it. But your salvage value at the end should be equal to your book value. So your book value is cost minus accumulated depreciation. So if in year 1 my entry is depreciation expense of $150,000 and accumulated depreciation of $150,000, notice depreciation expense is an expense. Expenses are temporary accounts. We close them out each year to retained earnings. So in year 1, it'll have $150,000 in it. You wipe it out to 0, then I add $120. You wipe it out to 0, then the next year it has $90. However, accumulated depreciation is a contra asset, and contra assets aren't wiped out to zero. So after 1 year, I have 150,000. After 2 years, my entry will be 120,000, but I still have the 150 in there. So now it's what, 270? And after 5 years, I have 450,000. So my cost of my asset, 500, minus my accumulated depreciation of 450 is going to give me my book value of 50. It will always equal salvage value in the end, and so remember that. Okay, so now the item gets this method, sum of the year's digits, gets a lot difficult, more difficult with a partial year. Okay, so I really want you to pay attention to this yellow line first. In year 1, I bought it on May 1st. So I take, again, 5/15 times 150,000, but then I need to take the 150,000 times 8 from May to December divided by 12. So I've got $100,000. But that's 2017, assuming I bought it in 2017. Okay, however, I still have 4 months left of the asset's first 12 months of life. So for instance, if you were born on May 1st in 2000, let's say you're born May 1st, 2000. By December 31st, 2000, you've only lived 8 months. So you live your first year of your life 8 months in 2000 and 4 months in 2001. You live your second year of life 8 months in 2001, 4 months in 2002, again, because your birthday is May 1st. So I have to do the same thing with an asset. So if you look at this little sheet here, and ignore my colors for right now, but in each of these cases I have an 8 and a 4. So this 8 is 8/12 of the 150,000 or 100,000, and this is 4/12 of the 150,000. And you can see I've got an error in there. Let me pause that. Okay, so I have 8/12 and I have 4/12. So if you notice, it adds up to 150,000. And then the next year I need 120,000, but I'm going to split up that 120,000 into 8/12 and 4/12. So 80 plus 40 is 120,000, but I split it into 2 parts. And the next year I do 8/12 of 90,000 and 4/12 of 90,000. So again, 60 plus 30 is 90, 40 plus 20 is 60, 20 plus 10 is 30. And so now I'm going to add them to my calendar years because I'm recording depreciation for the year. So in 2017, I have 100,000. In 2018, I have the last 4 months of its first year of life and the first 8 months of its next. So I've got 80 plus 50, so 130,000. In year 3, I have 100,000. 60 plus 40. Year 4, I have 70,000. So stop the tape and just really look at this and notice that I've got calendar years here. I'm just flipping calendar years. So my entry is depreciation expense, accumulated depreciation for 100,000 in 2017, 120,000 for 2018, 100,000 for 2019. Okay, and then now let's do the last one, double declining balance. In double declining balance, the formula for double declining balance is 1 divided by the life times 2. So in this case, my life is 5 years. So I'm going to take 1 divided by the life of 5 years times 2. And I get more than 0%, but so I get 40% of 1 divided by 5 times 2 is 40. And I simply take the book value times the rate. So notice in all other ones I use 450,000, and even in straight line up here, cost minus salvage value is 450,000 divided by 5. But in double declining balance, I don't use the salvage value. You're going to find out I kind of use it in the end, but in this case I don't. So I'm going to take my book value. My book value is cost minus accumulated. So I take 500,000 cost times 40%, I get 200,000. I've simply added these in here for when I own it a fraction of the year. So my depreciation expense and accumulated depreciation in year 1 is 200,000. In year 2, I take my cost. My cost is 500,000 minus my accumulated, which is 200,000, and I get 300,000. So I take 300,000 times 40%, I get 120,000. The next year, I can do one of two things. I can take my 500,000 and I can subtract my accumulated, and I get 180,000, or I could have simply just taken the 300 minus the 120 because I've subtracted the 200 in that one. And I get 72,000, and then the last year I take my book value minus my accumulated depreciation, and I get 108. So notice in the last year, my book value is 64 if I did the 40%, and if I get 25,920, I have accumulated a 461. But remember, I only want to depreciate at 450,000 because in the end, I want my cost minus my accumulated depreciation to equal my salvage value. And so I know my cost is 500,000, and I know my salvage value is 50,000. So I know I want my accumulated depreciation to be 450,000 because I wanted my book value to be that. So what happens in the last year? I don't do that. I just plug the number. So notice I've got 35,200. So if I take 14,800 in the last year, I get my accumulated up to 450. All right, so year one, 200,000, year two, 120,000, etc. So what happens if I purchase it on May 1st? Well, if I purchased it on May 1st, I need to take the $200,000 times 8/12, okay? So in year one, I'll take 133,333, but notice that my book value is the 500,000 minus accumulated, which is now different than it was. So I have a different book value times 40%, and I owned it for 12 months in year two, so I don't have to change that formula. So notice down here, my last year is going to be a little bit different. So I know I want it 450,000 minus 420. So I want 29,200. And so now I just plug in that last year. So that's double declining balance. So I'm going to minimize that. And you can look at your PowerPoints if you want to see some tables, etc., on how to do it. And I think they also have an extra one. The next thing we're going to talk about is group and composite. So group method and the composite method are kind of used for the same type of thing. So let's assume that we bought desks and chair sets for every room at Quincy University. So the question is, do I want to set up every desk and chair set separately, or do I just want to mass them together in one big depreciation? And the answer is I can use the group method for that because these are similar in nature and have approximately the same useful life. So since they're all desk and chair sets, I can do that. I could even buy other furniture and fixtures which have about the same useful life as a desk and chair set. So let's say it's 10. The composite method is if I have dissimilar assets that have different lives. So I'm sure if you would guess what you do with this, you average it. So let's look at the next slide. And here I have 3 different types of assets. They originally cost $145 with a residual of $25. So again, they probably even grouped these together before they came up with cars. It has a 3-year life, so I've grouped them together, and then I'm now going to have the composite one. So I figure out my depreciation on them on a group basis. All of them have a 3-year life. And I have depreciation of $56,000 out of the cost of $224. So I'm basically taking 25% a year, and my composite life is 3.39 years. So that's all a group and composite is. The important thing is when you sell a group asset. So if you think about the steps of, let's pretend that this is one asset and I've depreciated it 1 year. So its cost is $145,000 and I have depreciation of $40,000, so my accumulated depreciation is $40,000. So my book value is $145 minus 40, so my book value is $105,000. Okay, so let's assume that I sold it for $120,000. So if I take the steps, I get the car off my books as a debit balance, so I get it off my books with a credit. I get the accumulated depreciation off my books, so I said I've only done it 1 year, so I debit it for $40,000. And then I record the cash, and I said I got $120,000 cash, so I debit cash for $120,000. And then I plug the difference to a gain or loss. So in my case, I got $120,000 for an asset that's on my books at $105,000, so I had a $15,000 gain. So again, the important things are the steps: get the asset off your books, get the accumulated depreciation off your books, record the cash, plug the gain or loss. When you have a group or composite depreciation, it's difficult to say which specific accumulated depreciation you have and which assets you have, and etc. So what you do is you never record a gain or loss, and I'm going to mix up the steps, and you basically plug accumulated depreciation. So look at this next one. So with a cost for $5,000, they sold it for $26,000. So let's go through the steps. Get the asset off your books. So notice I just call it car, truck, and campers because I put them all in there together. I don't record the accumulated depreciation. I'm going to save that for the gain step. I record the cash of $2,600, and my accumulated depreciation gets debited for $2,400. So you notice it buries the resulting gain or loss in the accumulated depreciation account. And most of these, it's because it's immaterial. Okay, there is one other method. It's really, we don't talk about it much, but if there's a reason that you would change your depreciation method a little bit because it makes your financial statements more accurate, then you go ahead and do it. It just has to be systematic, and it has to be a rational reason why you're doing it. Okay, now we're going to talk about changing depreciation rates. So what happens if I have an asset for 5 years and I think it's going to last me 10? And after 5 years, I decide it's going to last me 8 instead of 10 or 12 instead of 10. What happens? And what happens is you just fix it now and in the future. So for instance, I have, let me simplify this a second. Hold on. Okay, so let's say I have a $100,000 asset that I think is going to last me 5 years. Okay. So what happens is I have my $100,000 minus salvage value divided by life. So I'm going to assume the salvage value is 0. So I'm going to divide it by salvage value, and I have $20,000 a year. So what if after 3 years, so after 3 years I've got $60,000 of depreciation, I find out that assets, remember I've taken 3, doesn't have 2 years left on it. So I've taken 3 and I had 2 years left for the 5, but I think I have 4 years left on it. It's honestly simple. I've got $4,000 I haven't yet depreciated. Instead of taking $20,000 a year over 2 years, I take $10,000 a year over 4. So I just simply take $40,000 divided by 4 years left. If I have a salvage value, which we're going to do in this one, you factor it in also. So we've got Acadia purchased equipment, so this is on your handout, of 510, which has a useful life of 10 years and a residual value of $10,000 at the end. I've taken depreciation for 7 years, and in year 8, I've determined the total life should be 15. So be careful. Sometimes this tells you how many years are left, and sometimes it tells you how many total years. In this case, the total life is 15. I've taken it 7 so far. So 15 years minus 7 is 8 years left instead of 10 years minus 7, 3 years left. So I've got 8 years left on this asset. And notice the residual value has changed. So what journal entry to correct prior year depreciation? I don't correct changes in estimates. I only correct changes in accounting principle or correction of an error. And this is not an error. This is an estimate. So what I need to do is figure out how much depreciation I've taken. So first of all, I do cost minus salvage value divided by the life. So I don't know that I would set it up exactly like that, but cost minus salvage value divided by the life is $50,000 a year for for 7 years, so I've taken $350,000. So now I've got to figure out how much have I not depreciated. Well, I've got my equipment of 510 minus the 350,000 I've depreciated it, so my book value or my undepreciated value is $160,000. So now I have to spread that cost over its remaining life. But what I do is pretend that's the new cost. So remember the formula, cost minus salvage value divided by life. All I'm going to do is my new cost, which is the 160, minus my new salvage value, which I believe is 5,000, divided by my remaining life, which I believe is 8. So 160 minus new salvage value divided by years remaining gives me 19,375. Also, let's assume that, let me add one more thing to this. What if I was, in order to get it to last 15 years, I did a major improvement, and that improvement cost me $20,000, okay? So remember, if it significantly extends the useful life of an asset or significantly increases its value, I add it to the cost of the asset. So what I would do here is just add that cost to right here. So I'd have the $160,000 plus whatever I spent on it. And you may say, well, last class time you told me we reduce accumulated depreciation. Well, if I reduce accumulated depreciation by 20, it's still in essence, I subtract a lower number, so in essence this still goes up by $20,000. So I would add the cost of fixing it to this and continue on with my computation. So this would be 180 minus 5 divided by 8, etc. If I had a major cost that I added to get it there. Impairment. Impairment is not systematic. So what are impairments? You can kind of read through these on items that kind of indicate impairments. It's on slide 36. Just read through them to kind of see that, or pause the tape and read through it. Notice impairments have to be permanent, so you can't just say, all right, my value of my building went down because the market went down today and maybe go up tomorrow, etc. It has to be pretty permanent in nature. So the first thing you're going to do is figure out, am I going to get more out of the future cash flows than it's on my books for? And if so, then I need to write it down. So let's go through an example. Okay, so are the expected future cash flows less than the carrying amount? In other words, what it's on my books for. If I go back to that asset I just did, notice it's on my books for, it's on my books for $160,000. Okay, so if I was testing it for impairment, I would say how much stuff is this equipment going to make, and am I going to get its $160,000 back out of it from what it makes? And if not, then it's subject to impairment. You can read through that. So in this one, we have 650 first. So the carrying value is 600,000. Why is my 650 not there? Oh, I'm sorry, it's right there. Okay, so my equipment's carrying value is 600,000. Book value, carrying value and book value are the same thing. 800,000 minus accumulated depreciation, but it's 650,000 going to bring in expected future net cash flows is 650. So right now I can do this. They kind of, hold on, can't get it to step through it, so you're going to have to bear with me and just follow your handout. So my expected cash flows, I don't know that I would have done this step, is 50 is more than the carrying value, so there's no impairment. So basically I do nothing. So next one, what happens if my expected cash flows are 580? So again, I go through a lot of steps for something simple. So I have a $20,000 impairment, and so I need to record that impairment. So now I do the recoverability test. So I've got 580. So then I go to step 2. So this is a little bit confusing in that you kind of want to, I can't figure out why this is not working. Okay, so this is a little bit confusing because you do this test, but you don't use the number. All this means is you go to the next step. So the next step is then, okay, it's subject to impairment, so how much do I write it down? So what happens, assume it has a fair value of 525, and so now I write it down from 600 to 525. So I have an impairment loss of 75,000. So step 1 just is, do I write it down? And if so, then I write it down to the fair value. So my impairment loss is simply to debit a loss and credit accumulated depreciation. You don't really necessarily want to credit equipment. You want to put the equipment on your books for the cost, but notice I just added to my accumulated depreciation, so my book value goes down. Restoration of impairment loss, basically you don't do it. Okay, there's no restoration of an impairment loss in an asset held for use. What do? You just depreciate the remaining life, just like we did if we revised the estimate. So anyway, however, if it's assets held for disposals like inventory, we're reporting them at lower of cost or net realizable value. You can write her up or down, et cetera, et cetera. However, I'm really going to stick with the fixed asset part because this is not the inventory chapter. This is the fixed asset chapter. So really, let's focus on fixed assets in this chapter. Depletion. So natural resources are depletion. So remember, if you have intangibles, it's amortization. If you have natural resources, it's depletion. So remember we said every cost to get the asset ready for its intended use is added to the cost of the asset. Well, acquisition, exploration, development, and one thing that kind of goes against the idea of ready for its intended use is this last one, but restoration costs. So I would actually include the cost to put the, let's say I was going to mine and I was going to have a strip mine or something, I would have to replace the ground to look like it did before. And so I would add those in the numerator. So these 3 are definitely a cost to get the asset ready for its intended use. This one is kind of not exactly that, but they include it in the base. So that might be the exception. All right. So look, it's the same as units of activity. Cost minus salvage value divided by life in units will give me my depreciation cost per unit. So however much I took out is my depletion. So you have this one in your handout. We acquired the right to use 1,000 acres of land in Alaska to mine for silver. The lease cost is $50. Exploration costs are $100, so I add that, so I have $150. And intangible development costs are $850. So $850 plus $100 is $950, plus $50 is $1 million. And I'm going to get 100,000 ounces of silver out of it. So my depreciation cost is $10 per ounce. So I need to figure out how much did I mine that year. So if I mined 25,000 ounces, my depletion is $250,000. So notice our general entry for depreciation is debit depreciation expense and credit accumulated depreciation. Well, feel free to use the accumulated depletion account. But notice they mined the silver, and the silver they're going to sell, so they're not going to debit depreciation expense, or depletion expense in this case. They're going to debit inventory. If I was doing timber, I would debit, my timber because I'm going to sell the logs at it. So basically, if you think about it, it should make sense. Feel free to do inventory and accumulated depletion. That's fine. And then the last thing is we're going to have a homework, I believe, that uses timber, and it can kind of be complicated because timber grows. And so just like we're adding to the cost of an asset, if we extend its life, we might change that, but we'll go through that. Okay, the last thing is liquidating dividends, and I'm going to go to Excel for a second. Okay, so let's assume we started a business, so we have 0 retained earnings in the beginning. I made $100 of net income, and I paid out a dividend of 20. So my earnings that are retained by the business are 80. And then next year, I started out the year with 80 because I ended the year with 80. And then I made $120 of net income and paid a dividend of 40. And so my ending retained earnings are 160. So then the next year I have 160. I made income of 300. So here's my question. How much can I pay out in a dividend? And the answer, some people say it's 300, but dividends can be paid out of current and retained earnings or accumulated earnings. So basically, I can pay out a dividend that wipes retained earnings out to 0, but I cannot pay more. Okay, and if I do, it's not a dividend. So when I sell stock, so let's say I sold stock for, let's say I sold 50 shares at $20, okay? So I've got 50 shares times $20. So I have cash of $1,000. So common stock, I'm going to credit, I'm going to credit for its par. You have to be given the par. So let's say the par is $10. So I have 50 times $10 is its par. And the rest goes to additional paid-in capital. So if you don't recall that additional paid-in capital is simply there because if my stock has $10 par, but I sell it for 20, I've got to put it someplace. So that's additional paid-in capital. And common stock is certainly capital that's paid in. Okay, so what happens if I write a check for $500, that can't happen. I can only have $460 of dividends. But what if I write the check for $500? And the answer is, you've given some of this back. So in essence, I kind of flip the entry a little bit. However, I don't give them their stock back because the stock is still out there. So the only place I can take it out of is right there. So look at this one here. I'm going to go back to your handout. So I have the retained earning balance of 160, 1,650,000. And I have paid-in capital in excess of par of $5.4 million. I declared a $3 dividend, so it's $3 million. But notice I only have 1.65 in retained earnings. So I paid cash of $3 million, but I can't debit retained earnings and put it down to a negative balance. So I wipe it out to 0, and the rest comes out of paid-in capital. This book doesn't go into what happens if you don't have enough paid-in capital. There are also some legal issues with doing that. But first it comes out of retained earnings, wipes to 0, and then paid-in capital. As far as presentation issues, you can just read that. That's honestly, this is really honestly no different than, let's say I have a machine and I'm going to make t-shirts. Clever, right? What happens with the scrap from a t-shirt if I ruin some is, should I spread the scrap over the cost of the old t-shirts? Or maybe a better example that I've used in the past is, let's say I'm going to make 100 cakes and need 200 eggs, but I use 212 eggs because I break some. Is the cost of the 12 eggs, should it be included in the cost of the 200 cakes because I expect to do that? Or should it be a loss account? And that's the same thing with oil and gas. What should I do with my efforts to drill and I don't run into any oil down there, so I have a dry hole? So what happens with the cost of drilling a dry hole? Should I only capitalize the costs of drilling successful projects, or should I add the cost of drilling unsuccessful holes to, should I capitalize them to that? So it's the same concept. Okay, so what do I have to present in the financial statements? I have to present the depreciation expense for the period. I have to show my major classes. If you pull up an annual report, that usually means it's land, furniture and fixtures, equipment, buildings, etc. So you might see 4 or 5 major classifications. Accumulated depreciation. An interesting thing about accumulated depreciation is you don't have to break it out by major class. You can just put one number for all accumulated depreciation. So you'll also often see 4 or 5, 6 lines. One will say the top one's land, then buildings, then equipment, furniture and fixtures. They'll total it up and subtract accumulated depreciation. A general description of the method or methods, which basically means double declining balance, straight line, etc. Then you have asset turnover ratio. Asset turnover ratio is a net sales divided by average total assets. So let's look at this one for a second. And I guess I need to make it large here. Okay, so I started the year with $131,000 of assets, and I ended the year with $132,000 of assets. So I just kind of average them to get my average assets for the year, so 131.5, or more specifically, whatever in the heck that is. Okay, and what I do is I buy assets to generate sales. So how efficient am I in utilizing my assets to generate sales? Okay, and my answer in this one, you can't see it, but it's 5.6 down there below this. And so what happens is what I said is it's 0.56 down there. 56 cents of sales is generated per dollar of assets. So what I would do is compare that to other firms in my industry, compare it to last year to see if I'm getting better. Here's the problem with this one. That's sales. This ignores expenses. Okay? So we're going to, next one is profit margin on sales is net income divided by sales. So this one tells me for every dollar of sale, how much winds up as net income. So let's say you shove $1 into a soda machine. Let's pretend soda's $1 still. How much of that winds up, of that dollar you put in there, winds up on the bottom line as income? And in this case, I have my net income divided by my net sales. So the answer is, you can't see that, but 21.96. So 22 cents of every dollar winds up as net income. And then the last one, remember the first one I said is the issue is it just uses sales. Well, this one uses net income. So this one considers expenses. So same thing, denominator, but I'm in net income, and it's 12.37. So what happens there is I can use my analysis and say, remember, this one's net income divided by average total assets. I can ask myself, where is that coming from? Is it coming from I have the fact that I have a high markup on sales, or that I'm efficiently utilizing my assets to generate sales? Also know that if I have my 70.56 cents of every dollar turns into, 56 cents of sales is generated per dollar of assets. I wish they put this in a point. 12 cents of net income is generated per dollar of assets. So the difference between that, why does 56 go down to 12 cents? Because of expenses. So you can also analyze that out of it. Of 56 minus 12 is the amount of expenses that I have per dollar of assets. So it's just a method to do that. And we are done. And just for little informational purposes, you don't need to do this because this is tax, and we may talk about it briefly, but just to see if you're reading this, and when you turn in this little handout, draw a little flower right there on the last page. Do your best to draw a flower. You can draw a rose, you can draw a little lily, or you can draw a daisy, whatever you want, but just draw me a little flower so I know if you're watching this. Thanks, and it'll be fun, and I'll get to see your flower.